FDR once said, "There's nothing more important for the stability of our nation than to have a system of homes owned by the people who live in them." I tend to agree with that statement. And I think families are the basic unit that give our nation its strength. And the home is where those families can flourish and hopefully grow a modest amount of wealth as they pay down their mortgage. Homeownership in America has long been of interest to me. So for my research project in this course, I wanted to answer this question. What role did mortgage securitization in the 1980s and 1990s play in transforming homeownership into both an entrepreneurial opportunity and a systemic economic risk? This question matters because it examines one of the most consequential financial innovations in modern American history. Let me briefly define what I'm talking about to make sure we're on the same page. Mortgage securitization is a process where home loans are bundled and marketed as tradable securities. This financial innovation greatly expanded the capital base for mortgages, but it also obfuscated the relationships and risks borne in these mortgages. It all began as a policy effort to stabilize housing finance after an increase in interest rates caused the thrift crisis of the 1970s. And I'll show you here some graphs that illustrate how this style of financing quickly became a structural pillar of buying a home in America. Those sections at the bottom, agency and GSE pools and private MBS, are all securitized. And look how quickly they seize over half the market. And this graph shows that the entire market for mortgages was rapidly expanding as well. To investigate this transformation, I relied primarily on congressional hearings, government reports, and financial industry publications from the 1970s all the way through 2010. These primary sources provide direct insight into how policymakers, regulators, and market participants understood and justified the rise of securitization. Congressional acts from the 80s and 90s codified the expansion of securitization into the housing market. Multiple Senate committee hearings from the 80s and 90s portrayed securitization as a stabilizing force and a tool for advancing homeownership. Early 2000s reports from Moody's Investors Service reveal how rating agencies rationalized risk models and that later failed. Testimony from Federal Reserve officials show how deeply securitized assets had penetrated bank balance sheets. And finally, the Dodd-Frank Act stands as the legislative capstone that revealed the excesses of securitization. I combined these primary sources with an analysis of economic data by examining the Federal Reserve flow of funds reports to trace the growth of mortgage debt and the changing ratio of securitized versus portfolio-held mortgages from 1964 to 2004. I'll quickly share the results from those again. This empirical evidence supported the congressional discourse, showing that the rapid growth of securitization corresponded with rising systemic vulnerability and declining loan quality, the same risks lawmakers had begun to identify in their hearings. In addition to these primary materials, I engaged with a wide range of secondary sources, from economic historians and financial scholars, including Kenneth Snowden, Richard Silla, and Mark Zandi. These works provided context for understanding how securitization evolved from a policy experiment into a defining feature of late 20th century housing finance. The findings of this research point to a clear conclusion. Mortgage securitization was both a triumph of financial entrepreneurship and a failure of risk governance. During the 80s, securitization revived a collapsing mortgage market by linking it to broader sources of capital. Wall Street firms, such as Salomon Brothers and First Boston, transformed home loans into investment products that attracted institutional investors worldwide. This innovation democratized credit and lowered borrowing costs. I think most people would agree that on the surface, this was a good thing. Capital was unlocked so that more people were able to purchase the homes that they lived in. However, it also decoupled lending from accountability. Originators no longer bore the consequences if these loans defaulted, and rating agencies were mispricing this risk, even sometimes accepting bribes to inflate ratings, as later congressional testimonies would reveal. By the 90s, securitization had expanded beyond residential mortgages to include commercial loans, auto debt, and credit cards. Policymakers celebrated this as a sign of financial modernity, yet the very features that made securitization efficient also made it fragile. When subprime defaults surged in the mid-2000s, the entire network of interdependent institutions unraveled. The collapse of Bear Stearns and Lehman Brothers in 2008 exposed how interwoven securitized assets were within the global financial system. The Dodd-Frank Act represented a political and intellectual reckoning with this history. Provisions such as risk retention, enhanced disclosure requirements, and the creation of the Financial Stability Oversight Council reflected the recognition that securitization did not need to be eliminated, but its risks needed to be properly managed. The reform effort sought to restore balance, preserving the benefits of liquidity and access to credit, while mitigating the risks of poorly aligned incentives. In conclusion, this research demonstrates that securitization embodied the dual nature of American entrepreneurship. It's inventive, adaptive, and ambitious, yet sometimes prone to excess and blind spots. Thank you.